often get from beginners: how can I sell something I do not own? How can I sell something I do not own? Well, think of it as the insurance company again. In this episode of Trading on the Road, we are in Houston, Texas, having a small coffee and trade event with members of the Houston Options Trading Group. The clip that we are sharing is when we are talking about the basics of options. Please enjoy and leave a comment, good or bad. All right, so let's talk about some basics of options. It's super important that you always kind of revisit the basics of options. And we talk about here at the Dorian Way, we talk about 3 pillars that you want to understand regarding the basics of options. We talk about the first pillar being what is the call and the put and what's happening when you buy a call and the put. And this image here is indicating that, right? It's telling you what's happening there. The second pillar is understanding the options chain, because that's how you buy and sell options and how you figure your probabilities of success and your risk. That is super important. And then the third pillar is understanding the basic option strategies, because if you understand the basic option strategies, you'll be able to understand all the different things that we at the Dorian Way come up with, or others outside of the Dorian Way come up with, because they're just deviations from the basic strategies, right? You have the naked put, you have the naked call, you have the call spread, you have the put spread, you have the iron condor. Those are basic option strategies, and everything else is just a deviation from those. Okay? But what I want to talk about is understanding what's happening when you buy a call or a put and sell a call or a put. Okay? When you are the buyer of an option, you guys have heard me say this analogy before. When you are the buyer of an option, you should think of yourself as the purchaser of insurance. You're going to an insurance company like Progressive or Geico, and you're buying insurance from them. You're buying protection. Monies are coming out of your purse, coming out of your wallet instantaneously. You're buying something, just like in the real world. Okay? And when you buy a call, you are bullish, as this arrow is indicating. You want it to go up. Monies are coming out of your account, and you need it to go up, and you need it to go up fast, because you have time decay working against you. Okay? You have time decay working against you. You have the odds against you. When you go buy insurance from a car from Geico, you know they have the probabilities on their side. Right? They're going to win the super majority of time on you from that policy. Right? Because they, just like when you go to the casino, you know the casino has the odds on their side. They're going to win the super majority of the time, and if you play long enough. And that's the same with the insurance in the insurance world. So when you're buying a call, you're bullish and you want it to go up, but you want to know that the best probability you can have, literally the best probability you can have, is 50-50. It can't be greater than 50-50 when you're the buyer of an option. But that doesn't mean you shouldn't buy an option from time to time, especially a call, to see if you can have a huge home run, a grand slam type of play. But when you do it in a way that if you lose a small percentage of your account, 1-2% of your account. But if you win, it can be substantial. It can be meaningful to your account if you buy that call. Okay? But understand the probabilities, understand what's happening when you buy that call. When you buy a put, you are bearish. Okay? You're bearish and you want it to go down. Buying a put is so much more capital efficient than selling shares. You can sell shares, and technically you're borrowing the shares from someone else, and you are selling those shares, and then you're buying those shares back to make a profit. It's just the opposite of when you buy shares. When you buy shares, you want it to go up, and then you sell it. That's how you make money. When you sell shares, you want it to go down, and then you buy it at a lower price, and you made the money from the difference. But sometimes you can do this on shares that have hard to borrow, and it's just a little bit more headache and a lot more capital potentially you have to use when you are selling shares to be bearish, or you have more risk to the upside, right? You theoretically have unlimited risk to the upside when you sell shares to be bearish. Okay? When you buy a put, you can still control 100 shares, for example, and you have defined risk. But the best probability you have when you buy a put is 50-50. That's the best probability you can have. Most of the time, it's going to be less than that. The super majority of the time, it's going to be less than 50-50 probability of winning if you hold something to expiration. All probabilities are based on holding to expiration. But when you buy this put, you're bearish, you're negative on the underlining, monies are coming out of your account. Once again, you're the purchaser of insurance for the most part. Okay? Now, as you look at this image on the right hand side, if you're the seller of an option, then you are what I like to call the one man or one woman insurance company. You are Geico, you are Progressive. You're running your one man, one woman insurance company in an open market. Right? You're deciding who you're going to write a policy for. You're deciding what that policy price is going to be, how long that expiration of that policy is going to be, how long that policy is going to be. You control absolutely everything when you are acting as the one man or one woman insurance company in open market. When you're initiating a trade, you control everything. After, you don't control much, right? You are acting, you're on defense, as the old kind of sports analogy goes. Okay? But I often get from beginners, how can I sell something I do not own? How can I sell something I do not own? Well, think of it as the insurance company again. You are the insurance company writing the policies. You're creating a policy. Okay? When you go to a new insurance company, let's say you were Geico and you decide to go with Progressive. Well, Progressive they don't have a policy on you yet. You don't have a relationship with them yet. So what they're going to do is create or write a policy for you. Right? They're gonna determine what is the risk of writing a policy for you, and once they determine that, that's going to be the premium, and you'll have a deductible perhaps. But they're creating something out of thin air. They're creating a policy that's not there yet. And that's the same thing you're doing in the open market as a one man or one woman insurance company in open market. You're creating the policy. You're the seller. You're writing a new policy for someone. Okay? And that's why you get to control all the factors, all the criteria of that policy. Okay? So if you are the seller of a call, then you are bearish. You want it to go down as this arrow is indicating. You are negative on that underlining, and monies are coming into your account instantaneously that you never have to give back. Because once again, you're an insurance company. If an accident occurs, you can put that monies towards the accident, just like the insurance company does. Progressives and the Geicos and other insurance companies. If you get an accident that supersede the premium you paid them or the deductible, they can still put that stuff towards the accident to make the accident less costly to them. Okay? So the seller of a call is bearish. It's the opposite of buying a call. When you buy a call, you're bullish. You want it to go up. You can be bullish or bearish using just a call. It all depends on you buying it. If you're buying it, you're bullish. If it's and you're paying monies. If you're bearish, you're selling it and you're receiving monies. Okay? Now the seller of the put is bullish. You want it to go up. Monies are coming into your account once again, and you're writing a new policy to someone that is being bearish, right? Because if you're selling a put, someone is buying it, right? It's the opposite. Okay, so you can once again be bullish or bearish just using a put. It all depends on if you're buying it, which is bearish, you're paying monies out of your account, or if you're selling it, which is bullish, you're receiving monies into your account. So this is a little circle, right? You can be bullish or bearish using a call or a put. It all depends on how you're doing it, and there's so many different combinations you can do to create strategies with these calls and puts. Okay? And that's what makes options so phenomenal and so strategic. It's amazing how options work, and you want to learn them, and you want to learn them on a basic level like this so that you can just extrapolate that into understanding options at a high level. Okay? You have to understand the basics. You have to have that foundation before you can soar. Right? Before you can soar. All right, so this is what I wanted to explain about the basics. Any questions to this point?